Wait already. Well, greetings and salutations, test takers. This is the Series 7 Guru, aka Dean Tenney, coming to you with one of our Wednesday evening classes we do. We try to do them every other week. Tonight, we're doing a class on direct participation programs, partnerships, on your Series 7, 2, 3 questions. Problem is we don't know which 2 or 3 questions, so we got to cover everything. If you're taking another exam, maybe 1 or 2, any FINRA NACS exam, if you tell me you missed your mark because of partnerships, I'm going to say, you probably had some bigger problems elsewhere. The first key thing here is direct. Direct, you're making a direct investment. You know, when you buy Chevron, for example, you buy Exxon, for example, you're not making a direct investment into oil and gas. You're buying stock in a company that's in the oil and gas business. And, you know, all those tax consequences are trapped within the corporate shell of Chevron or Exxon. You know, you don't get, to write off depreciation. You don't get to take a depletion allowance. If you get rid of that corporate wrapper and you make a direct investment into oil and gas, then the tax consequences will flow through. Now, the most common type of a direct participation program is a partnership. As an investment vehicle, our clients are going to provide money. The general partner is going to provide experience. At the end, our limited partners have had the experience and the general partner has the money. I'm joking, but our first learning objective here tonight is to recognize the structure of a direct participation program or partnership and differentiate between the roles of a general partner and the limited partners. You know, I used to sit on the floor of the Warrior games before I retired and moved to Las Vegas from the Bay Area. And the former owner of the Golden State Warriors was a guy named Chris Cohan. And, he got into trouble with the IRS for an abusive tax shelter, and he had to sell the Warriors, and he sold it to a partnership. And the general partner is a guy named Joe Lacob. You know, I didn't know at the time, but 2010, I'm in the VIP bar. Tony, who's been my server for years, I said, I just need a cocktail. I want to watch the Giants in the World Series and then, go on the floor to watch the Warriors. And anyways, this guy came over my table. He's hovering and I'm thinking, what's this guy's story? He goes, well, how do you get a drink here? I go, you can go to the bar and order one. I thought, what's going on with this guy? I'm kind of blowing him off. He goes, what do you think about the new ownership group? I said, well, I'm not a big fan of the partnership model of owning a sports team. I like the sole proprietor model where I was thinking Larry Ellison was going to win, and he dropped 400 million, and then you have 30 billion behind that, and so I can't believe he didn't win that auction. The idea that me and 20 of my buddies are going to come up with 20 million apiece to buy the Warriors just doesn't speak to me. And I'm going on, and they finally said, "Well, I got to introduce myself. I'm Joe Lacob." I said, "Well, I got to walk that back." In a gazillion years, I never thought you'd care about anything I had to say about the partnership. All right, so the IRS doesn't like partnerships. And the reason the IRS doesn't like partnerships is they don't like the flow through of the tax consequences. People who don't understand the partnership structure don't understand this flow through. For example, my buddy is a partner at a law firm, and every once in a while somebody would say to me, what do you think his salary is? I said, he doesn't have a salary and he wouldn't want a salary. He goes, well, what do you mean? I said, well, they organized their law firm as a corporation. That law firm as a corporation would make money, pay taxes, pay him a salary, he'd pay taxes, pay a dividend, they pay taxes. As a partnership, that just flows through. Now, if you ask me what I think his partnership distributions are, I think that would be millions. I mean, that's why somebody there will work their ass off to become partner someday, so all that money flows through. I had somebody making fun. I don't know why you would be making fun of our industry if you're coming into our industry, but he was saying derogatory things about Edward Jones and their business model. And I said, well, you can say what you want, but Edward Jones is a partnership. And some of those people you make fun of as baby brokers may make partners someday. And the average partner at Edward Jones has a flow through of $400,000 in distributions. You might want to be partners someday. So the IRS says, how are you different from a corporation? Because the IRS says if you look too much like a corporation, you quack too much like a corporation, You're going to pay taxes like a corporation. And so the test question here is, what are the 2 of the 6 characteristics that are easy to avoid? This first one here is hard to avoid. Corporations have employees, partnership have employees, they have associates, shareholders, partners. We're 0 and 1. Who cares? It doesn't matter that we're 0 and 1. We need to get to the 2. Partnerships have to have a profit motive, subdue corporations. The first broker dealer I worked for was an S Corp, and S corporations have a flow through of the tax consequences. And I said to Jeffrey, I said, we could make money if we tried. He said, well, Dean, this is an S Corp, and there's a flow through of the tax consequences. So these losses are flowing through to my dad's tax return. This is a tax shelter for my dad. I go, really? I walked down the office. I said, hey, Mr. K, can you tell me something? Are we trying to make money? He said, well, Dean, of course we're trying to make money. I'm embarrassed that you even would ask such a silly question. I just have it as an S Corp. So in these early years that we do lose money, it'll flow through it. I can write it off. And when we start to make money, and lots of it soon, I hope, it'll flow through it. I'll be taxed on it once. Test question. If IRS wants to talk to somebody out of business enterprise, should I send them to Jeff's office? This is a tax shelter for daddy. Or Mr. K, who says the tax benefits were important, but economic viability is the most important consideration. Ding, ding, ding. You can't be doing this just to lose money. You can't let the tax tail wag the investment dog. So we're 0 and 2. We're 0 and 2 because we have to have a profit motive in any business structure, including a partnership. If we have too many tax benefits without economic viability, I told you this how Chris Cohan lost the lawyers. The IRS came after Chris Cohan for back taxes, penalties, and threatened to prosecute him for fraud if he didn't come up with like $180 million. And the only way he had to come up with it was to sell the lawyers. Centralized management, we're 0 and 3. Corporations have centralized management. They have corporate officers. That's centralized management, a president, a CEO, a CFO, a COO, centralized management. And partnerships have centralized management, a general partner or partners. So we're 0 and 3. We're 0 and 3. Shareholders have limited liability, and limited partners have limited liability. We're 0 and 4. We need 2 to the rescue. Shares in a corporation have a freely transferable interest. Partnerships do not. So this is an easy one to avoid because we just tell our partners that you do not have a freely transferable interest. You can only transfer your interest with permission of the general partner. So, test question, we shouldn't put a partnership into a customer's portfolio if they need liquidity. Very testable to know that because there is not a freely transferable interest, partnerships have a lack of liquidity. One of the limited partners and the lawyers put up more money than any other partner. He was a limited partner. He was called, his name was Vivek Ranadivi. And he was upset that they ended up doing well and he was not a GP. He didn't want to be a GP at the beginning because he didn't want to have unlimited risk. And he said, damn. He wanted to sell his interest in the lawyers to go buy the Sacramento Kings. And so he needs permission of the general partner, Joe Lacob, to do that. And he said, well, who are you going to sell it to? So to be admitted or emitted, get into the partnership or be emitted, you need permission of the GP. To the rescue, we need 2. Continuity of life. Partnerships have a finite life. Partnerships have a finite life. What we mean by that is, we say at the end of 10 years, we're going to sell off all the assets and terminate the partnership. That's not true of corporations. Corporations have infinite life. They go on and on and on. Bank of New York, for example, is older than our country. 200 plus years they've been carrying out a business and dividing the gains with the shareholders. Not a partnership. My Edward Jones example, the partners every 2-3 years vote whether to continue the partnership or not. Corporations, we don't take votes about whether we're going to carry on or not. Right? So the continuity of life. The test question, if you get it, is the 2 easiest things for a partnership to avoid are freely transferable interest and continuity of life. I used to use this in my practice. I would call somebody and say, "Hey, welcome, partner. The partnership agreement is how we sign you up to become a limited partner." And it's very testament that limited partners have limited liability, and they have no management responsibility. You wouldn't want any management responsibility because that could violate your limited partnership status. And if you're deemed to be a GP, well, remember that means you have unlimited loss potential. So, you got to stay out of the day-to-day affairs of the partnership as you're a limited partner. Partnership democracy. I've been involved in numerous partnerships, and one of the partnerships we were involved in, I called a partnership meeting and I said, "Listen, we're here tonight to decide whether we want to switch the general partner. This isn't working with this GP. Or do we want to dissolve the partnership?" It was an iffy proposition about whether we're going to continue on or whether we're just going to call it a day. And my buddy Brian, he said, "Well, Dean, who are you proposing as the general partners if we boot the GP out?" I go, "You and me. Okay, we're going to have an adventure." I still haven't, I just heard from him out of the blue a while back, and he reached out on LinkedIn. He said, "Dean, I still am remembering fondly, even though we lost some money, those partnership days and, what an adventure it was." And I'm going to reach out. As a limited partner, you can copy the books. And we live in a very litigious society. You can always sue anybody about anything, right? So we can sue the GP. So as a limited partner, we said you have no management responsibility. You can monitor the books and records. We said partnership democracy says you can vote for the general partner. You can remove them if we have enough votes. I don't know what level of hell Al Davis is burning in, but he was the general partner of at the time, Oakland Raiders. His son, Mark Davis, is now the general partner. And Al Davis only owned 40% of the Warriors, or excuse me, the Raiders, 40%. And there were dissident partners who wanted to get rid of him, but the partnership agreement said it takes 2/3 of the partners to remove the GP. So as long as he has 40% of the partnership interests, he ain't going nowhere. One of the people wanted to sell their 20% owner in the Raiders. Al Davis said, "Well, listen, you can only sell that 20% ownership interest with my permission. And so you may think it's worth a lot of money, but the only person I'm going to let buy it is myself. And so it's really not all what you think it's worth, right? You could sue, and we said you have limited liability." GP, test question, has unlimited liability, has management responsibility, has a fiduciary responsibility. We should definitely know what fiduciary means. Fiduciary means you're acting in the best interest of a third party, right? So that's what that word fiduciary means. So, Joe Lacob should be running the Golden State Warriors for the benefit of the partners, not for his own benefit. It would be a conflict of interest for the GT to borrow, JP, general partner, to borrow from the partnership, to compete with the partnership, and to commingle funds. On all our exams, commingling is a bad word. I say, your money, my money, what does it matter? And we find that we got the, the revenue from the season tickets in Lacob's personal account. I just made that up. It's not true. It's segregated. So segregation is a good word on these exams. Commingling is a bad word. Commingling is when we can't distinguish whose monies are whose. And, partnerships, have some nasty stories and some bad reputations about what we're talking about. GP's gone bad, right? What do general partners do? General partners have the management responsibility. We talked about their conflicts of interest in terms of borrowing from the partnership, competing against the partnership, commingling we discussed, and the general partner is a fiduciary, and the general partner has unlimited liability. Liquidation priority. So as we said, partnerships are kind of unique in how they're structured. In other investments, like stocks or bonds, you get a return on your investment. At the end, a return of your investment. Right? So if I buy a bond, for example, I get paid every 6 months the interest, and then at maturity, I get my principal and my last interest check. Partnerships are a little different. Partnerships, we start by returning the capital to you. Wow. So we make distributions that reduce your cost basis. So in my example, the cost basis for the partnership called the Golden State Warriors was 400 million. And I would be willing to bet you that all of those partners have already received back their 400 million. So now the idea is we're playing for free. When we do liquidate the partnership, the secured creditors come first, then the other creditors and limited partners. GPs come last. And a general partner usually is taking a bigger bite out of the back end. So that's how general partners are making their money on the back end. Now, when we're setting up a partnership, we're going to file our certificate of limited partnership in the state of domicile. That's the fancy for where are we headquartered? Where is the partnership domiciled? Where's it headquartered? Is it Delaware, California? Where is it, domiciled? By the way, this could be important because we have exempt transactions under 33, and one of those exempt transactions is called Rule 147. And so whether we're doing a 147 deal to raise equity, common stock in a corporation, or whether we're doing a 147 deal to raise money in a partnership, there's a state of domicile, the 80% rule would say if we're going to use a Rule 147, the issuer has to have 80% of their business and assets within whatever state that happens to be. Very, very testable again. So when you're raising money, whether you're raising money for a corporation or whether you're raising money for a partnership, here we're raising money for a partnership. And if we're raising money for a partnership as a private placement, this was probably 90% of my practice when I was a broker, was raising money for private partnerships. Now, private equity funds, venture capital funds, hedge funds, those are all organized as partnerships. And Carlyle and TPG and Blackstone and Kleiner Perkins, these are all the general partners. And in a private placement, whether we're doing stock, we're selling unregistered stock in SpaceX, for example, or whether we're selling unregistered partnership units, chat is open. Do you know the rules about this safe harbor under 33? If you ask an attorney what is safe harbor is, that means how can you do what you want to do without getting in trouble? And so if we are going to sell these partnership interests in a Reg D transaction, for example, I raised some money for some wineries in Napa, and we raised that money using Reg D. Nobody wants to participate in chat? What are the rules about a Reg D private placement? Maybe I have the thing so you can't talk. I don't think I do, but remember, if it's an exempt transaction, it's either going to be 506B, 506B, or 506C. And these are safe harbors under 33. And I just told you I was raising money for wineries. And that means we can have in a private placement an unlimited number of institutional investors. And we can have an unlimited number of accredited investors. If the chat's not working, you're welcome. There you go, Erica. Accredited investors. And Erica is correct. She says, Dean, the accredited investors with 506B, we can have up to 35 non-accredited investors. When I was doing a private placement for the winery, which was a partnership, I told the general partners, I said, listen, I would like to use 506C because if we go with 506B, we can have up to 35 non-accredited investors, but we can't solicit. And I would like to be able to solicit. And welcome to our world, every once in a while I would get somebody who I'd be soliciting to invest in the winery, and they'd say, you're not allowed to solicit. I said, I am allowed to solicit. Like, what do you mean? This should be by invitation only. I said, no, 506C, I can have no non-accredited investors, but the distinction is I can solicit. And then remember, accredited investors is very testable. So Erica nailed this 506B versus 506C. But again, this is whether we're talking about partnership interest, but whether we were selling unregistered stock, it'd be no different. What is an accredited investor? Are you guys aware of that? Very testable. What is an accredited investor? A good way to remember an accredited investor is 1, 2, 3. 1, 2, 3. $1 million net worth, $1 million net worth, or $200,000 for the last 2 years, with the expectation of $200,000 this year, or married and filing jointly $300,000. Indeed, right? For the last 2 years, with the expectation of that this year. 1, 2, 3. I have some good news for you. Maybe you don't meet the accreditation standard, and you said, damn, I've always wanted to be able to invest in private placements. Well, I've got good news. With your Series 7 or your 65 in good standing, what that means in good standing, meaning you're associated with a broker-dealer on the 7 side, or as a 65, you're associated with an investment advisory firm, you too are accredited. Woo! Right? So another dividend from passing your exams. Now, we can also sell these programs publicly. If we're selling it publicly, up to 35 non-accredited investors for 506B. There's 2 versions. So if I'm using 506B, I can't solicit. I cannot solicit, but I can have up to 35 non-accredited investors. Yeah, and that's what we're saying. We don't have to register with the SEC. Now, if we're doing a public program, we're going to be using a prospectus. And, if we're doing a public program, our syndication fees are limited to 10%. So, if we're raising, for example, $10 million, that's our raise, put that in green, no more than 10% in syndication fees. So my winery example, if it's a public deal, it wasn't. But if it was, maximum commission on 100 grand would be 10. Right, so here would be a maximum of $100,000. Subscription agreement, the limited partner is going to verify their net worth. They understand the risk. And remember, the biggest risk you get tested on, I don't know of any exam where you're not going to get tested on the lack of liquidity in a partnership. Because we said you can't get in or out of the partnership without permission from the GP. You're effective when the GP signs. So I used to use this as an opportunity. I'd call you up and say, Shally, welcome to the partnership. You have been admitted to our partnership. So welcome, partner. Welcome, partner. A specified program is what we tell you we're going to do with the money. Right. So I say we're raising $10 million. So one of the ones, my big deals that I was involved in when I was a broker was called Del Taco Restaurant Properties. And what we do in Del Taco Restaurant Properties is we'd go out and raise $8 to $12 million, buy all cash real estate and build Del Tacos. We did Del Taco Restaurant Properties 1, Del Taco Restaurant Properties 2, Del Taco Restaurant Properties 3, Del Taco Restaurant Properties 4. We did 4 of these syndications. And these were blind pools, meaning we didn't tell you which real estate we were going to purchase. And we would say, listen, this has more risk, but it gives us more flexibility in, negotiating with the real estate to get those pads. We're going to put up those Del Tacos. So blind pools have more risk because we're not identifying the assets. In my example, if we're raising 10, less than $7.5 million has been identified. Now, a specified program is when I say, here are the properties in Del Taco Restaurant Properties 2. We've identified over $7.5 million worth of property that we're going to put in the program. The test question is a specified program where we tell you what we're going to do with the money has less risk than a blind pool where we say, we'll figure that out, later. Right. So, okay, well, taxes. So, on your tax return, you have three buckets or spigots, right? So this is a spigot, and this spigot throws off from the partnership passive income or passive losses. You know, you probably are familiar with your portfolio. The way I think of it, not testable, but I think of it as on my tax return, I have my paycheck income. That's me working for money. I have my portfolio income. That's my money working for me. And so let's say that on my paycheck income, W-2, 1099, the IRS calls this earned income. Let's say that Dean has $90,000. And you probably already know that when I net out all my gains and losses from my portfolio, let's say when I net all my gains and loss, realized gains and losses, I have a $12,000 loss. And you should know that can I take that 12,000 against my 90 and tell the IRS that I made 80 $78,000? So can I net the 12,000 against the 12 on my tax return and say I made 78? Anybody know the answer about how much of that portfolio loss I can take against my paycheck? The most I can take is $3,000, right? So Dina's going to be able to say I made $87,000. And what do I do with the rest of it? I carry it forward, right? So now I took three of theirs, so now I have 9,000 that I can maybe use next year. And that is testable. It's a recognition question about this 3,000. Nobody expects us to be an account. Now, the reason I brought that up is because in partnerships, there is no way to sneak any money from there. What happens in partnership stays over here. So all this passive income or passive losses cannot be taken against anywhere else. You can't take anything from the portfolio or passive or the portfolio or paycheck. So whatever happens here stays there, right? And I like this little slide here. So boom, there's our partners. There's our income and expenses that flow through, right? It's not a corporation because remember, corporations don't have a flow through. The corporation makes money, pay taxes, or loses money. It's stuck within that corporate shell, right? So, well, REITs are completely different. We are not talking about REITs right now. We're talking about partnerships. Now, REITs only pass through income. That is correct. But we aren't talking about a REIT. We're talking about partnerships. We're talking about partnerships. Tax form. So the K-1 is the distribution form. Your K-1 is how we report to you as a limited partner, either your passive income or your passive loss, right? So that's the form we use. Back when I was a baby broker decades ago, I was able to buy as leads K-1s, which was a great lead source because you would tell me what your distribution was. I don't know if you can do that anymore, but the vast majority of your questions on partnerships are the various types we have. And so our learning objective here is the various types of direct participation programs and how they're offered, right? The only two ways you can make money in an investment is the income stream and or price appreciation. The income stream and or price appreciation. So in any investment, partnership or stock or anything where there's no income stream, then appreciation is your major objective. So if we form a partnership to buy raw land, appreciation is our only objective because there is no income stream. If we do new construction, we form a partnership to build new apartment buildings or new hotels or something like that. We have no immediate cash flow. So again, appreciation is the major objective. If we buy existing properties, we typically will have some cash flow, some rent coming in. So those are our three types of real estate partnerships. We also have tax credits. Woo! A tax credit is a dollar for dollar whack out of your tax bill. So be careful, ladies and gentlemen. Previously, I showed you a deduction. We took $3,000 against my paycheck income. That was a deduction, not a credit. A credit is a dollar for dollar whack out of your tax bill. So I say, listen, our partnership is being formed to invest in government-assisted housing, low-income housing. And you say, gee, Steve, how are we going to raise the rent on these tenants if it's low-income housing? I said, well, you're right. We can't raise the rent, so we're not going to have much upside, or as much upside as we would in a regular kind of commercial real estate transaction. And we're not going to have as much cash flow potential. But hey, we get a dollar for dollar whack out of our tax bill. That's pretty powerful incentive to invest in low-income housing, which is the whole point of providing the credit, right? And it is testable to know the two types of direct participation programs, partnerships, that provide tax credits. Historic rehabilitation. If you ever visit San Francisco, one of my favorite places is on the corner of Montgomery and Jackson. And there's an old brick building that's been restored to its former glory. And it says, William Tecumseh Sherman was a market maker here. In the 1850s, he worked in that building and he provided liquidity in mining stocks. And the doctors formed a partnership and they bought that building and they restored it to its former glory. And now they're the tenants. So they're the partners in the building and they're tenants. And I bet those doctors could use a dollar for dollar whack out of their tax bill. Various types of partnerships. We have equipment leasing. We're going to go buy some airplanes and we're going to lease them. Computers, risk of obsolescence. Those computers look pretty bad. I like the containers. The containers are going to never go obsolete, I don't think. In fact, I'm coming to you from a converted container. I bought this container and I had these guys turn it into my studio. So, it's 40 by 8 feet, whatever, One of the concepts that we have in partnerships is a concept called depreciation. You don't get to use assets for free. And so we have to charge the assets for its use so that way, when it's past its useful life, we have the resources to replace it. So depreciation is a non-cash expense. I don't know what the useful life of an airplane is. But the neat thing about the depreciation is it will shelter the income we're receiving from the lease payments. So depreciation is non-cash expense. I'm going to explain this a little bit better to you in just a moment. But what I want you to remember right now is depreciation is a non-cash expense. And I'll point that out. We have oil and gas programs. It's very testable to know that the most aggressive partnership we have is an oil and gas exploratory program known as a wildcat program. Wildcats go places other cats don't go. High risk, high reward. Developmental, known as a step-out program. We go next door to somebody who found some. If they found some, it's likely we'll find some. Less risky. Combination is a little bit of both. And then the safest, I didn't say oil and gas incomes are safe, but as partnerships go, oil and gas income is the safest type. That's where we buy proven producing reserves. Proven producing reserves. When I sold oil and gas programs, when I was in my career, I sold income programs. I said, listen, we're only buying, properties, mineral rights on properties we know there's oil. Whether it's profitable is a different thing, but you drill a hole anywhere in the Permian Basin, you're going to find oil. Taxation. So we want to identify here in this last learning objective this evening is the tax ramifications of investing. And the big picture we said is what, happens in a partnership stays with that partnership. There's nothing that's coming from your portfolio or your passive income or passive losses over anywhere else. So, the concept is we have passive income generators, partnerships that, toss off cash, toss off passive income. I call these not testable, just my term. I think of these as pigs. Pigs. And then we have partnerships that also throw off losses. And I think of it not testable as pals. And so what we want to be able to do is match our pigs with our pals. As I said, those losses aren't doing any good. So, I was one of my go-to moves for the private placement partnership winery was, hey, doctor, why don't you meet me up at the winery? We'll do a due diligence tour and tasting. After we do the due diligence tour and tasting, we can talk about whether you want to make an asset allocation to the winery and join us as a partner, limited partner. On the way down to his automobile, he said, hey, Dean, I appreciate what I've learned thus far, but, this would be ridiculous for me to invest in yet one more direct participation program, one more tax shelter. I said, well, doctor, I'm kind of a little offended that you would refer to this investment opportunity as a tax shelter. It is not. Are those other partnerships you have, were those tax shelters? Because, Dean, it's embarrassing. I've got so many passive activities, losses. And I said, well, as you know, those are stuck there. They're not doing anything for you. And this winery throws off passive income. To suck up all those passive activity losses, I think you need to make an asset allocation of $300,000 to the winery. By the way, I think he thought he was just going to fold up shop. He ended up doing $300,000. Cool. So we want to match our pig with pals. Maybe I call you and I say, hey, we have a lot of amount of passive income from your partnerships. And why don't we take a flyer on an oil and gas exploratory program? If we don't find oil, we can at least use those losses, those pals, those passive dealers to suck up passive income. So this becomes a suitability question about matching up a partnership likely to provide passive income if my client already has passive activity losses, or a partnership that provides passive activity losses if my customer already has passive income. All right, so in taxation of partnerships, remember the tax consequences are flowing through. And so just like any other business structure, your expenses are deductible in the current year. Cost recovery systems are accounting entries. They're not cash expenses. As I said, depreciation is a non-cash expense. You don't get to use assets for free, so we're going to charge the asset for its use, real estate or equipment, so we can replace it at some point. Depletion is for a natural wasting resource. I don't know how much oil is down there, but this I do know. If I pump a barrel and sell it, there's one barrel less. So the depletion allowance is to give me an incentive, a tax incentive, to go to find a replacement barrel of oil and gas or replacement gold or whatever the case may be. We're going to have a partnership meeting, and I'm going to go over the tax consequences. I'll play GP, you pay limited partner, and we'll see how you do. Integral drilling costs is like doing the geological survey, doing that kind of stuff. It's not part of drilling the hole, and we get immediate deductions for that. So, if I pay a geologist to go do a survey for me, he says, Dean, I'm going to need a helicopter, I'm going to need a boat, I'm going to need this or that. I said, not a problem. It's deductible. We talked about tax credits already. Now, cash flow is the real money. And remember, depreciation is funny money. It's not real. So, we're going to do a partnership where we go acquire an apartment building. And we're going to collect rent from the apartment building. We're going to have operating expenses from the apartment building. And commercial real estate has a useful life of 29 and a half years. Let's call it 30. So, that depreciation is the non-cash expense or depletion. We're doing real estate, so we're going to have depreciation. And then we're going to make interest payments on our mortgage. And then based on that, we're going to report to the IRS because remember, there's no retained earnings. The partnership itself has no tax consequences because the tax consequences are flowing through. So I say, well, welcome partners, right? We're going to go through the accounting here. So we said passive income or passive loss. This can be a pass through. And as I said, direct participation programs are either a PIG, that's not a test term, that's a Dean term, a passive income generator, or the direct participation program is a PAL, a passive activity loss. It generates one of the two. As we said, what we want to do is match passive income with passive losses. So revenues exceed expenses, it's a passive income generator. Now, this is my terminology, not test terminology. The test point is this idea of matching passive income with passive losses. That's the test point, not Dean's vocabulary about pigs and pals. If our expenses exceed our revenues, we got a passive activity loss. Now, the point is knowing recognition-wise that you cannot use passive losses for anything other than passive income. So it's not like your portfolio where you can take $3,000. If you have a loss over here, it's stuck. You can't do anything with it except suck up, passive income. We said cash flow is the real money. And we said depreciation is a non-cash expense. So cash flow, we can either not put the depreciation in to do cash flow or back it out. With math, there's always a lot of things to do. And we said depletion is an allowance for a natural wasting resource. All right, so let's do a partnership. I'll play GP, you are my limited partners. So I'm the GP, you're the limited partners. I say, welcome partners. As you recall, we formed a partnership to buy an apartment building for $275,000. As you recall, we got a $240,000 mortgage, and we're paying 10% interest on that mortgage. Our results for this year, because I want to tell you what you can expect on your K1, is we had rental income of $48,000. We had operating expenses of $15,000. And we took a depreciation charge of $10,000. Now, remember, partners, that's not real money. That's just a non-cash expense. And we had interest on the loan of $24,000. So we're going to tell the IRS this year that our partnership lost $1,000. And so you, this year, partners, K1, have a passive activity loss, your portion of that $1,000. And you say, whoa. I said, well, now hold on. This is kind of a neat trick. We had positive cash flow. Right? If we throw back in that, I put $9,000 more into our checking account. So we would love to do this. We would love to continue to report losses as our bank balance continues to grow. The takeaway, remember, is the depreciation is a non-cash expense. This is how people in real estate get rich, right? They're telling the IRS that the apartment building is going down in value by the depreciation, but it's not. At some point, we're not going to have enough depreciation to offset that income, and then we're going to have a tax consequence. But, again, way beyond the desk. I would also comment that all test prep vendors, my God, all test prep vendors, don't get me on a rant, go way, way overboard on partnerships. Way overboard. I can't tell you how many people are asking me about recourse notes and non-recourse notes, and I feel bad because it's not stuff they're going to see on the actual exam. When I get weak, if people say, Dean, do I have to read the book? I go, yes, you have to read the book. Cover to cover, twice. When I get weak, people say, do I have to read the book? I go, well, maybe you don't have to read the balance sheet section, the margin section, and the partnership section, because those sections on all test prep vendors are completely overkill in terms of the reality of what you're going to encounter on the test. Cost basis, I said here, what we're trying to do is return the capital to you where you're playing for free. So, Loika didn't ask me if I wanted to be a limited partner in the Lawyers. What can I say? But, let's say he did. I said, okay, so Joe, what do I need? He said, well, Dean, we're signing up 20 partners for $20 million apiece. And so I got to come up with $20 million. So my cost basis may or may not be $20 million, deciding on how I do this. So I say, Joe, here is my check for $5 million of the 20. And here is my recourse note for $15 million. I'm telling the partnership, the Golden State Warriors, they can go borrow money on my behalf to make this investment. And if things go according to plan, the investment will pay off the loan, the partnership. And if it's recourse, my cost basis is, in this example, is $20 million. Now, same scenario. This is mainly a test prep vendor thing, not a test thing, but same scenario. I say, what do I need? He says, Dean, you need 20 million. I say, okay, here's my check for 5. And here's a non-recourse note for 15 million. Exact same thing now. The partnership's going to go borrow $15 million on my behalf, and I hope the partnership can pay it. But if not, the bank can't come after me. There's no recourse to me. So in that example, my cost base is 5 million. So in my example, I put up 5, I borrow 15. If that note is recourse, the cost basis is 20 million. If it's non-recourse, 5, I borrow 15, it's 5. The exception would be real estate, because real estate, remember, is non-recourse. What they do is they foreclose on the property. So the mortgage that we got on that apartment building at 240 is part of my cost basis. Evaluating the direct participation program, as we said, you better tell the IRS you're trying to make money. Economic viability, cash flow, capital gains. I did an internal rate of return assumption and figured out what the present value is and made sense. Who cares what I just said? I'm just saying you have to have made this investment because you thought you could make some money. You can't be doing it just for the tax benefits. Disproportionate sharing is typical. And what it means is the GP gets more on the back end than he put up, right? So it's disproportionate sharing of income and expenses between the GPs and the LPs. We talked about cost recovery systems. The one we talked about was depreciation, non-cash expense. We talked about tax credits, very testable for historic real estate, low-income housing. We talked about passive losses can only be used to offset passive income. And recapture means, I tell the IRS my cost base is 0, and now we sell the lawyers for $2 billion, $3 billion, $4 billion. So that's recapture when we end up selling the asset for more than our cost base, and I owe taxes on that. IRS, that's not good. An audit, they say, hey, Dean, why don't you come down here and explain those numbers to us? Why don't you bring your accountant? Why don't you bring your attorney? Uh-oh. Recourse note, we talked about the risk there. The risk there is the investment doesn't pay off the loan, then the bank reaches out to me and says, hey, Dean, that recourse note you signed for $15 million for the lawyers, and it went south and it didn't work, and you owe us $15 million. So the risk here is that the bank is going to collect on that recourse note you signed. They're not safe, not liquid, very testable. Lack of GP experience running similar programs. When Lake bought the Warriors, I said, what do you know about running a basketball team? I mean, you're a general partner at Kleiner Perkins, and I'd be the first to admit I was wrong. This guy knows how to run partnerships, broad basket, and a sports team as well. So length determination of the partnership. Maybe we think we're going to get out in 5 or 10 years, and we don't. All right. So remember, inch by inch, your exam is a cinch. Yard by yard, your exam is hard. Do you have any questions about our discussion this